We recently shared a video with you. Is it the market, management, or trade structure that gets you in trouble in uncertain markets? In that presentation, we discussed the idea of flipping the script of popular option strategies such as the covered call, cash secured put, or others. And instead of capping the gains, leaving the downside open as those strategies do, approaching a new trade as capping the losses guaranteed and leaving the upside open. This is to protect the core of your trading account. You've built up wealth in the market. Maybe you have unrealized gains to protect, or you're starting to build an account. Shouldn't you protect your investments and prepare against uncertainty? You can create a low-risk structure and stack the market odds in your favor. Aren't things such as credit spreads, debit spreads, and just buying calls or buying puts low risk? Well, we might argue that they are known risk, not necessarily low risk. Without discipline, proper position sizing, and correct management, one can lose the entire amount invested in those strategies and really get behind in the portfolio. These strategies have their place, but again, with discipline, proper position sizing, and management. In the core of your account, what is the flipped trade? We know that covered calls, cash secured puts, and other positions don't allow the winners to run, and they don't cut your losers short. They do the opposite. They cut the winners short, where you may have to continue to roll positions to try to get more upside, or worse, they let the losers run, even with a stop order at 5 or 6%, a sudden overnight decline down 15, 20%, you need to make up a lot more of those losses. The three core principles of any options trade is that we need to force an ideal size trade, so we're not risking too much on any position. We need to take advantage of the time decay curve. We want to put time on our side, whether we're selling or whether we're buying. And at the same time, we need to be on the proper side of the at-the-money bell curve for the strategy that we're using. Fifth, forcing an ideal size trade. We need to make sure that the potential loss in any position in our portfolio is kept to single digits, guaranteed. And that can't be done with a stop order and the unexpected happens. But at the same time, we want to leave the upside open while still being in a structure to generate income and lower that initial low risk that we started with. Time decay. The time decay curve of an option shows us that the decay of the time is much slower when we look at options that are further out in time, 150 days, 160 days or more. We want to buy further out in time. Whether we are speculating with a smaller portion of our portfolio for just call or put buys on growth positions or positions we feel are going to decline. Maybe you're doing calendar spreads, diagonal spreads, or the poor man's covered call. You want the long option to be further out in time to see less time decay, or for protection, which is the most important. We want to put time on our side by buying protection on our core holdings that is further out in time. But when we're selling, to get that income, to lower our initial at risk, we want to sell closer in to get that rapid time decay in the last 30, 14, 7 days, while our second asset decays much slower. And the at-the-money bell curve. Where is the richest premium, the richest time value of any option in any expiration for any stock? It's the strike price that is closest to the current stock price, right at the money. You see a lower time value if you go further in the money, calls or puts, or further out of the money and calls or puts. So this tells us we want to sell near the peak, generating income closer to the current stock price, and we want to buy on the outer wings, in the money and out of the money, to put the advantage of the ATM bell curve on our side. What would be the proper structure that we're talking about to satisfy the three core principles? Well, direct from our married put search on December 2nd, we might have chose to buy and at Arista Networks at 123.28. And at the same time, we would have looked to purchase far out in time. May, expiration 2022, 130 put at 17.80. Now, does this increase my total cost? Yes, I'd put out $141.08 per share for the properly structured position. But I have a guaranteed exit at 130, meaning the most I could ever lose on this position in the absolute worst case scenario is $11.08 or 7.9% of the total investment amount. And that's really only going to occur if I hold the position all the way to expiration, make no adjustments, and my stock remains below 130, where all-time value is gone. This proper structure checks off all three core principles. We force a controlled risk below 8%, and we can't overtrade the position because of the force an ideal size trade. We put the time decay curve on our side for the protection. Initially started about 170 days out in time, and today, December 22nd, we still have 149 days to go of insurance in place. Following the at-the-money bell curve, we purchased the in-the-money put. And yes, we paid a price of $17.80 for that security. $7 of that was intrinsic. The $11.08 risk is just the time value alone. Now, of course, you can look at that structure and say, wouldn't the out-of-the-money option be cheaper? Well, of course. Lower strike price, further out of the money, cheaper cost, but you get what you pay for. Right now, ANET is trading at 138.07. What do we see with the at-the-money 140 strike? Well, it has a price of 16.10 and would carry a maximum risk of 9.7%. That's a little bit high. I'd want to focus more in the range of the less than 8%, maybe a 5, 6, or 7% risk, looking at the deeper in-the-money put options to control the risk, the proper single digits. Let's say I took the 150 strike, only carrying a risk of about 6 or 7%. It has a bid point of $22. That's fairly expensive right now. But take a look at the 125 put. It has a cost of only $9.10. Half, much less than half, of that 150 strike. But look at the risk. It's over 15%. It's in the double digits because that insurance doesn't kick in until the stock drops 13 points from 138 to 125. You lock in that loss plus the cost you paid for the position, which would be much more expensive than buying the in-the-money put up front and controlling the risk to single digits. Why so far out in time? Wouldn't a closer input, shorter term to expiration, be much, much cheaper? Well, that would go against the time decay curve, wouldn't it? We can see here that the 150 strikes on Arista for the various expirations, 9 days out, 16 days out, 23 days out, are fairly inexpensive compared to that May series we were just looking at the 150 strike, or the June series that's 177 days out in time. Less than half, again, roughly. But we're only insuring the position for 9 days, 16 days, maybe even 30 days. Let's take a look at the May 150 strike priced at $21.95. Yes, around $12 of that is intrinsic value, so the risk is $11.56 or 7.2%. It's roughly 150 days out in time, or 5 months. Now take a look at the 21st of January 150 strike that's 30 days out. It's priced at $13.50. The May option is 5 times the amount out in time, but it's not 5 times the cost. You have a lower annualized cost buying further out in time. And yes, we get a higher annualized premium, as you know, selling shorter term as opposed to selling a 6-month out or a 1-year out option. We want to put that annualized time in our favor. We want to be buying further out in time to have a lower annualized cost and keeping the risk to single digits and giving the stock time to move in our desired direction. That is why we use this structure. For the core holdings in our account, we're going to look for those bullish stocks that match our sentiment, but we're going to look to protect it with a put that's at least 150 days out in time to satisfy the time decay curve and the lower annualized cost opposed to buying month by month. The put should be in the money by a few strikes for the best risk control to get the single-digit risks, not going cheap and taking double-digit risks. And it allows us to force an ideal size trade with controlled risk, leaving the upside open, and we can still get income to further lower that risk and potentially have no risk on the trade. Well, how can we go from low risk to lower risk in this structure? Well, Annette offers weekly options. So, of course, we could generate premiums selling weekly calls. This is income method number 1, the first of the 12 different income methods discussed in the blueprint to lower our initial at risk, generate income, and potentially bulletproof the trade. But it has to be done correctly. Forcing an income method can actually increase the risk to the upside and see you taking larger losses than you initially planned. That is the benefit of the blueprint. It gives you a full description of each income method, a SIGA model for deciding when to use each income method against your position, when and how to use them, and also how not to use them, the proper use of each income method to keep you out of trouble and to keep the trade with low risk and lowering the risk moving forward. Well, a lot of you know how to sell calls. You know how to sell covered calls. You understand that if you sold a call in this structure, you'd essentially create a collar. And just figure, okay, well, if I did open a protected position, I can immediately start selling against it. Let's take the current price. Arista's bouncing at around 138 to 139 today. We could buy Annette at 138.48, and we'll take that June 150 put, 177 days out in time, at a price of 22.70. This would make my total investment 161.18, but we have a guaranteed exit at 150, so we're only risking $11.18 or 6.9%. And again, that's in the worst case scenario. If I held this position all the way to June expiration, made no adjustments, accepted no dividends, and the stock remained below 150 when all time value is gone. But yeah, we want to get that income. Arista offers weekly options, so why not sell that December 31st 140 call and get almost $290 in premium? It satisfies the ATM bell curve. We're selling right at the money to get the maximum time premium for the income we're generating. It satisfies the time decay curve, doesn't it? Because we're selling only 8 days, 9 days out in time, we're going to get rapid decay on that short-term option. But look at the structure now. This is not what we wanted. We started off with a risk of only 6.9% to the downside. How did the risk go up to 11.6% in this structure when we generated income which would have lowered our cost basis? Because the risk is now to the upside. We sold a call at the wrong strike price and too soon. And if the stock moves up in price, we've capped our gains at 140, and we can take a larger loss to the upside in the direction we thought the stock was going to go. This is an improper structure to use for income method number 1. Again, one of the reasons why the blueprint is so important. There is an income method that can generate income, lower the risk to the downside, and leave the upside open. It's one of the riskless spread trades in the blueprint. That's income method number 6. We'll generate a premium. We won't add any additional monetary requirement or margin for using this spread in the proper structure that we're using. We can lower the downside risk by the premium generated, and we leave the upside open in case the stocks take off. It's just another way to enhance the position. Now, what do we have in our structure? We've got a long stock position that we're bullish on, short term or longer term. And we bought a put option to ensure that position to control the risks to single digits. Our original position on December 2nd, the stock was trading at 123.28. We would have purchased the May 130 put for 17.80. The stock's now trading up at 138. Did my put decline in price? Sure. Now that the stock's at 138, my 130 put is now out of the money. But the put didn't go to zero. We still have 150 days of time value remaining. The original time value was 1108. Some of that 1780 that we paid for was intrinsic value. The time value was only 1108. But now that it's out of the money, the put's not at zero. It still has time value and is priced at 1095. We only lost about 13 cents of time premium. We can now use that remaining time to manipulate the position and take our out of the money put back to in the money. Further, lower the initial risk. What is that? That's income method number 4, one of the 4 ways that we can manipulate the put option, our second working asset. It keeps the time and the at the money bell curve on our side. Now that the stock has moved up, we could sell to close the May 130 put for 1095, and I could buy to open the May 150 put for about 2110. Why would I increase the cost basis by $10? Well, it's to get a 20-point higher payout. Now I'm guaranteed to get $150 back instead of $130. This is one of the only income methods that's actually done at a debit. But the benefit here is almost twofold. I increase my cost basis in the position by $10, and I'm going to get a 20-point higher payout. And as you can see here, that lowers my risk to only $1.23, or 0.8% on the position, while still leaving the upside open. Could I then take this position to no risk? Absolutely. How about that income method number 6 I shared to generate another $1.60 or $1.70 of premium, totally canceling the risk to the downside, leaving the upside open with this now lower risk by using income method number 4. That put is a second working asset, can be manipulated in different ways to lower your risk, lower your break even, or potentially profit in both directions in uncertain markets. Is it possible? Absolutely, it's possible. You can stack the market odds in your favor with the proper protected structure that matches the 3 core principles which really apply to any option strategy. You can take that low risk position to a lower risk position and then potentially having no risk or a bulletproof position. By the way, did I mention that Arista has earnings coming up in February? Wouldn't it be nice to go through the uncertainty of earnings, having no risk to the downside, and leaving your upside open to take advantage of further gains, and still having time to be able to adjust and increase your bulletproof status and guaranteed return while still getting income and leaving the upside open? And that is what is available in the blueprint. It's a full guide to properly control risk in the proper structure. 12 different ways that you can lower that risk, get income, and then potentially have no risk and a bulletproof status on your core positions. And now is the best time to purchase the blueprint if you want to start controlling your risk, lower your initial at risk, bulletproof trades while still getting income and keeping out of trouble. If you purchase the blueprint before December 31st at midnight, you'll receive these 8 special end-of-year bonuses. Discounted first 2 months of access to the Fusion subscription at radioactivetrading.com, where you can follow our trades, get more insights into various lessons to help you master the blueprint, and much more. We'll send you one of our Mastery Series videos, the Foundations of Radioactive Trading video, completely free. And you'll also receive access to the FIST video, the 4 Insider Secrets of Trading, completely free. You'll get a quick start guide to help you eliminate some of the guesswork or how to transition from covered calls and spread trading to protecting the positions in the core of your account with a proper protected structure. You'll receive 1 month of power options for free. You'll also receive instant access to the material. The blueprint is now all electronic, so there's no shipping expenses, no waiting for arrival, No fear about supply lines or anything of that nature. Of course, you receive email support and phone support completely free anytime you have any questions. And you also get instant access to members only content, access to a Blueprint Owner's member account at Radioactive Trading, where you'll be able to access members only white papers, members only webinars, and much, much more. But this offer does end at December 31st. So if you want to move forward the uncertain trading markets of 2022, go to radioactivetrading.com, click on the products tab there, and get access to your blueprint and start controlling your risk in the proper protected structure, generating income and taking your low risk trades to lower risk to potentially having no risk on your core positions going into the uncertain times, earnings, and much more.